Kaenan, how are you doing?
I'm doing great. I hope you're doing well with all the wildfires on the West Coast.
Well, I don't know. I do my best to stay at home and avoid people, fires, and the outdoors. This is my life here within this medium. But today I'm very keen to talk about Kin Insurance, especially because it's exciting. Another InsurTech is going public via SPAC.
Absolutely. And I think, Kin is facing some of the same challenges that carriers out in California are and the Pacific Northwest, where they're having, catastrophe threats. For Kin, most of their portfolio this past few years has really been around Florida and Texas. So hurricanes and hailstorms have been more of the problem. But, similar to Hippo, where they're exposed in California and Texas, this idea of how do you manage through natural catastrophes becomes critical for survival, and particularly how you price it. And we'll get into that a little bit later because I think Kin is doing some interesting stuff there.
Yeah, and especially so far they are licensed in 4 states, and part of this merger is to get the liquidity in order to buy, how do we call that? Not a domicile, but basically a dormant insurance company that will give them access to 40 states. So like that, there you just pay a little bit over $200 million and you have 40 states and access to those policyholders.
Right. Absolutely. And don't forget that Hippo, if we're, comparing a little bit, bought Spinnaker Insurance, who was already, they already had a relationship and they were already writing with them. But part of that reason was to both control the capital side of the equation and the flexibility. When you actually own the carrier, you can work with them in a much more flexible way to design the paper the way you want in the various policies.
Okay, great. So we jump directly to deal with the elephant or the hippo in the room, which is great. But let's take a few steps back, talk about what is Kin, their background, a company established in 2016 by Sean Harper and Lucas Ward. They sell homeowners, condo insurance, landlord insurance, and mobile homes, which was a little bit a surprise for me when I saw that. And their brand to the bigger audience, Better Insurance.
So don't forget that they, one of the things that distinguishes them from a lot of the other startups recently is their claim to only be direct to consumer. Right. While Lemonade might have started direct to consumer, they've licensed their APIs and product to other carriers as well as the agency channel, because most of these other startups have realized that the role of the independent agent in the States is particularly still very entrenched. And so consequently, if you just sort of lob that off, you lob off more than 50 or 60% of the insurance market right there.
And we saw that also with Root, and we're going to see that with other companies that at the beginning claimed to be 100% direct, but then started to move towards the more, let's call it incumbent or established distribution channels. I would say, for now, let's give them the 100% direct to customer, and we'll see how that's going to evolve.
Yeah, and if we look at the deal and we look at their metrics, it's from my perspective, an outside in. I mean, it's great for Kin themselves. On $25 million of revenue, they are raising about $242 million in additional capital at about $1 billion valuation. So that's phenomenal in that regard. And more importantly, it will allow them, as you said, to expand into the other states and do a lot more. But I think what to me is really surprising is that there's an indicative of the amount of capital out there, that a company that just generated $25 million in premium, right? Premium we're talking about, and it was not profitable premium by the time you back out all their operating expenses, found a buyer who was willing to pay, essentially $1 billion for that entity, or value that entity at $1 billion. When you read their public filing for the merger between the SPAC, which is called Omnichannel Partnership, which is founded by people from really the consumer packaged goods and marketing worlds, that is actually what they're talking about. The strength of this combined company is the fact that Bobby Brown, who redefined cosmetics, will help them redefine insurance. And so when you start to read through the documents, you sort of see how the acquirer, Omnichannel, is sort of looking at how they can use their individual expertise of their board members to really push Kin further into the public market. By that same token, maybe the flip side of that is really, maybe they look at Kin as a child, no pun intended, that needs a little bit of help.
Let's talk, about their insurance KPIs and where they stand today, right?
So as we talked before, I'd like to remind our listeners that these sort of going public documents, whether it's an S1 or others, really are that company's best foot forward. So they're going to try to gloss everything as shiny as possible to make this the biggest, brightest diamond in the world. And in fact, you do see a little bit of that. And in fact, in some places, it's sort of contradictory. In some places, they talk about a customer acquisition cost of $350. And in other places, in more places, they talk about it at $500. But at the basic level, their average premium, they quote, is $1,634, which is pretty decent, actually. Although when you think about it as being Florida has become pretty expensive. So it's not such a high premium as you would think, just given the fact that market is less competitive and the premiums in that market have been skyrocketing because of the hurricane seasons. But that $1,600 really isn't the total premium, and I know we'll talk about this a little bit later. That's really more like $1,471 in premium, plus a 10% tack on for a surcharge, so to speak, because Kin is organized as a reciprocal exchange. So the premium, part of that premium goes to funding the reciprocal and funding the capital in that reciprocal, which they need in order to satisfy the regulators, in order to satisfy them that they should be able to pay all of their claims. So that premium isn't as large as you would think, but the raw dollars to a policyholder, it's the same whether you look at it as $1,471 plus the 10%, or in total, that's $1,600. Similarly, they quote a retention rate of 92%, which is phenomenal. Don't forget they've only been really writing business for about a year, so it'll be interesting to see a little bit as they age. But if you look at retention a slightly different way in terms of premium dollar, so when you look at premium dollar from 20 to 21, where they started and where they ended, and what amount of that premium was renewal premium, that's only 84%. And when you look at their estimation for 2022, that's only 85%. So by no means is it 92%. It's really in the 80s. And their loss ratio of 77%, to me, one of the most amazing sort of statistics that they put in there is that within a couple of years, they expect that loss ratio to be closer to 40%, 38 or 40, depends on where you look at it. And that would put them at the highest end of any carrier writing homeowners insurance. And
but I think that it's as you said, it's your right leg forward, or the best leg forward, whatever leg you want. Especially in these documents, they're trying to show that that's the best. And we can talk about their data later on to show how they can be the best. But most definitely during their, in their presentation, they compare themselves to Hippo, to Lemonade, to Root, even Metromile, the other shiny InsurTechs that went public. And when we are looking at the number that you just mentioned, 92%, then you look at Hippo and you say, yeah, but that's only 85%. And then there are a few questions that we need to ask about, the customer cost of acquisition, and with that, the LTV to customer cost of acquisition ratio, because that will be a big differentiator where they stand and the economic unit. Because on volume, they're a little bit behind. But if we are super optimistic and we're looking at that atomic unit, they can be ahead.
Right. Yeah. And I think what we also need to remember is this lifetime value to customer acquisition cost metric is really more of a software as a service model metric than it is an insurance metric. Because at the end of the day, the insurance carrier, what do they really care about? It's the combined ratio. And their combined ratio is still going to be plus 100% in 2023. So you can't run a business when you're losing money on every dollar of premium. And in fact, when you look at their estimates of what they put for 2023, that their gross profit of $130 million, and in small print, it's minus customer acquisition costs. Well, you end up with a 30% loss, net loss, rather than a gross profit. I think they're going to lose $37 million. And so, eventually all of these startups will have to solve that customer acquisition costs and or operating costs model in order to bring their combined ratio down to a more manageable level. I do think that they have a pretty interesting model with that reciprocal, particularly on the reinsurance side. Lemonade is getting 25% commission back on the premiums that they're ceding. They're essentially getting 32% back on the premiums they're ceding. And if you think about the population that they're in, where there are cat losses, it's really, and they are giving up, I forget the number to the reinsurers, but that reinsurer number, I think they're giving up 64% of that to the reinsurer. There's really not much money left for the reinsurer if they have one cat season. And so it'll be interesting to see over time if that model will still hold, or will the reinsurers essentially want to renegotiate or even walk away from that deal?
That's a very good point, because this is where they will need to figure out how they structure it with the reciprocal. Maybe they will need another panel of reinsurance, something very similar to what Hippo is doing. But again, Hippo has its own structure, and we will need to do a different episode to talk about them and how they operate with the MGA, the agency, Spinnaker, and their structure. That will be an interesting conversation by itself.
So Gilad, if we think about their sort of insurance model, right? So if a person on page 38 of their document, they show the $1,000 premium, which is really $1,100 because you have your 10% surplus contribution to the reciprocal exchange. So of that $1,100, let's say, right, $100 has to go to surplus because you have to build up the capital base of the reciprocal. And so if you think of that $1,000, right, so 32 of that, 32%, so $320 is going to kin as a commission. 28% is going to the reinsurer.
Yep.
So 32 and 28 is 60.
Yes.
And now you have your loss ratio. Right now they're at 77%. So 60 and 77 is a really big number, well above 100. But they say they're going to get to 38% or 40% actually. So if you have the 32% plus the 28%, so you're already at 60 plus that 40,
it's 100.
You're now at 100%.
Yep.
Right. And going from 77% loss ratio down to 40 is going to be monumental, because most homeowner companies, and as they do their national and geographic expansion, they're not going to have, a loss ratio that low. And while the other thing that they talked about is they showed how they're going to get from 77 to 40 was they're taking rate increases. Well, rate increases, as we all know, put people into shopping mode. And when they shop, there's a higher percentage of those people that are going to leave. So the retention will suffer as you increase rates. So it'll be interesting to see, where their steady state ends. But with this model, they need to be perfect on pricing and perfect on their expected loss ratios, because with only 28% in a home insurance market, the reinsurers are probably not going to be so happy in a couple of years, especially if there are any major weather events.
And I think that we touch a couple of key points here. First of all, is the steady state. They are not there yet, right? It will take them a few years. They are talking about projection to reach this part, I think only in 3 years from now, hopefully to reach it. Even the 32% that is going to be sort of a dividend to the holding company, today it's about 28%, maybe something like that. So it's going to take them time to reach that. But let's talk about how they can actually make that happen, right? And that's part where their data kicks in. How do they select the right risk and the right, let's call it policyholders? Well, that's the risk, right? Market them, get that risk in, so they will, first of all, as you mentioned, will pay, and the churn will be slow. So low risk, high paying customers, and that will be there because it's very sensitive, and there will be some sort of a sensitivity test towards that, because once you put, you're putting the brand of it's going to be cheap, this is where you're preaching to the wrong audience. It becomes the race to the bottom.
Right. Adverse selection. So, it's what they present. They talk a good game. I'm not sure on the acquisition if they're as sophisticated as they are on underwriting. And the reason I say that is that their acquisition costs are still somewhere between 350 or 500. It's difficult to tell which number because they use both numbers.
It's remarkable. Even 500 for homeowners, that's an amazing number.
Right. Amazing high, amazing low.
Amazing low.
So I don't think it's so amazing low, because if you remember to what Hippo was saying, they were at $350, and that's a little bit higher than your traditional sort of call it national carrier, and it's certainly higher than the regional mutuals. But by the same token, it's less than what you're seeing Root or Metromile and their acquisition costs. But auto is a very different business. In any event, 350 or 500 is not sustainable given the metrics of the company and where there's their loss experience and their expense base. But so I can't, it's unclear if what they talk about their sophisticated attraction and marketing strategy, and maybe that's why the OCA people who have brand experience, who have marketing experience, who have customer package good experience, maybe that's where they'll bring value to the kin relationship. But what they are doing is they're using data and underwriting, and they do seem to be doing that very well, even at a 77% loss ratio. I think that's pretty good. And what they're doing, and that gets to being a direct to consumer and connecting to the front facing part of the application, is streamlining and validating what a consumer either has to input or what they did input, and therefore using that data from secondary data sources to help them in underwriting. So, you don't have to ask a person what kind of roof you have, because there are plenty of providers out there right now that can tell you what kind of roof it is, whether it's flat, whether it's gable, whether it's concrete shingles or asphalt shingles. Right, that data is readily available. You might have to pay for it, but if you can improve that customer experience, make the application simpler, and be more accurate in your underwriting, that's where you're going to get the efficiencies and the gains. And they do seem to be doing that. I'm not sure 10,000 data points per application is really what they're using, but by the same token, it does seem that they're using some data points to their advantage. So Gilad, I would think the last thing that we should touch upon is the stock price of Omnichannel.
Okay.
Right. So it's still below essentially the strike price of these SPACs, which is $10. So as of today, it was, I think, $9.80 something. But what I was really surprised after the announcement was that there wasn't a greater amount of volume traded in it, and that it didn't seem to move even, a few pennies. And it's sort of oscillated up the last couple of days and down the last couple of days. But we saw that also with Hippo, where it hasn't moved and it hasn't really broken its strike price since the initial announcements of the SPAC. Unlike a traditional IPO where we do see a lot of trading on the first days and we do see spikes either up or down, depending upon who it was. Lemonade is still the poster child of the IPO market. They're still well above their strike price. While they've come down 50% from their high, they're still in the 80s. And I think that might be more of a testament to launching in the traditional market rather than through these SPACs. And you see the SPACs suffering, in probably the majority of them suffer upon formation and upon merging with a company, irrespective of the industry.
So I'm not really sure if we can call it suffering. And it really depends who you're asking. Ideally, we need to ask the shareholders. But the CEOs, and that's my understanding, stability or lack of volatility at this point is very good for them because they know where they stand, they know the price. Later on, most definitely, it's all about the fiduciary. It's all about let's get those share prices up. So there will be a return to the shareholders, right? Cool.
Absolutely. Well, Gilad, I've enjoyed this conversation. Look forward to our next one.
Me too. It's been great. I know that we touched very lightly, although we can dive a little bit deeper. But of course, this means that we will need to talk about Hippo in the future and get more into the details as we also look at the performance of other companies. And again, folks, please send us your comments, questions, and if you have a company that you wish us to look at, let us know. And don't forget to subscribe on the YouTube channels.
And Gilad, when we talk about Hippo, are you going to wear a tutu or just be your normal self?
I thought about it. So it will need to be a pink tutu. And I'll try to get like a hippo or a beer belly or some sort of like a big gut. So it will make sense. I'll ask nicely from the Hippo team to send me, swag so we can have that. Actually, that's another, if you want to send us swag so we can wear your startup t-shirt.